right, and go.
Welcome, everybody. Thank you for your interest and time to join this very inspiring panel. My name is Woody Moore. I'm from InsurTech. I'm very honored to be in this panel, and I would like to introduce our very inspiring panelist. First of all, I would like to introduce Richard Lefleaf. He is currently EVP of a microinsurance company responsible for international business. And prior to that, he was a CEO of MicroInsure, an InsurTech startup. So the latest company is a merger of MicroInsure and the STB Group. And I learned from Richard that he has been doing this microinsurance for 19 years, which is very inspiring for me to persist in such a kind of noble cause for so long a time. So we are very keen to learn from him. And my next panelist is Namrata Jolie. Namrata is a very accomplished leader in financial industry, including asset management, trust banking, consumer banking, and insurance in a few organizations such as Credit Suisse, Citibank, and Prudential. And currently, she is a senior advisor of Pink Box, a pension in a box InsurTech company that is trying to really, enable pension coverage for numerous poor people in emerging markets. And she will share about her experience in that. Alex Chen is a young but a very experienced person as well in InsurTech. He has 6 years in the InsurTech space, and he started and was the CEO of Asia Risk Transfer, Singapore-based InsurTech startup. And currently, he's also doing advisor work for another InsurTech, climate-related InsurTech in the US market. So with that, I will start to ask questions to our panelists. The first question to every panelist is the problem statement. What is the problem you are trying to solve? Why is this problem not solvable with a traditional or conventional insurance approach? And why is it so important? So maybe I will start with Richard.
Sure. Good morning or good afternoon. It's good morning for me in England. I think the problem statement for me that I've been trying to solve is that traditional insurance companies have been around for many decades, and yet 97% of the population in many emerging countries still don't have a single insurance policy. And when I looked at this, it became very clear to me that this was an issue of distribution. So in many parts, the traditional insurance companies have just taken the kind of distribution methodologies that they were using in Europe and in America, and they've tried to implement them in Asia. And so what that looks like is bancassurance models, agent-led sales. And of course, if you have a sales process which is led by a person, the person costs a certain amount of money. They can only make a certain number of sales per day, which automatically leads you down the road of having a relatively high premium in order to justify the cost of the agent, therefore a relatively high sum insured. And if you have a high sum insured, then you need to naturally ask a lot of questions about the person's health, about their background. And this becomes very daunting and a process which is far too frictionful. So it's far too off-putting for the average consumer, not even for the low income, for the middle income as well. And this is, and I'm convinced this is why so many people don't buy insurance today.
Thank you. That's a very good summary, Richard. Next, Namrata.
Hey, Woody, thanks for having me on the panel today. It's a pleasure to be joining this panel and discussion. So as far as a PIN box, which is, like you rightly said, pensions in a box is concerned, in defining the problem statement, and I would like to emphasize, while it's a problem statement, it is a big opportunity statement as well. So here we're talking about 1.8 billion people across Asia, Africa, and Latin America who today do not have access to a formal pension construct. And what that means is we are looking at this entire population walking into old age poverty. As we all know, they are now looking at a world across a lot of developing markets where you have an aging demographic. People are living longer, and at the same time, with them living longer with better medical facilities and so on, but not having any kind of a formal pension construct, it will mean them having almost 20 years post their working years being in abject poverty, which is a huge issue and requires action right now. So here I'm talking about micro SMEs. I'm talking about farmers, fishermen, not just micro SMEs, SMEs as well, and an extremely quick growing segment the world over, which is the gig economy. To further, just give perspective to the scale of this problem, by 2050, we will have a population of almost 2 billion people across the world who will be above the age of 65. Right? And 80% of this population is going to reside in Asia, Africa, and Latin America. And if we take a stance that, hey, shouldn't be governments be the one who are taking the call and making pensions available, the fact of the matter is, even putting aside a tax-funded pension of $1 a day is going to cost these governments $1 trillion just across a year, which these countries cannot afford to put aside and divert away from growth and infrastructure development and so on. And therefore, truly, there is the need of the hour for the private sector to get involved, because I will also cover the opportunity aspect, which is, if you look at encouraging, the young workers starting from the age of 25, of even putting aside $1 a day, and $1 a day is an average, because there are some countries where $1 a day is a large amount of money as well. So I'll just put this down as an average. But for someone who's 25 years old, putting aside that kind of money in a regular, disciplined way, and we'll talk about the solution, which obviously needs to be extremely flexible and needs to be brought together through a micro pensions ecosystem. You could easily have a person having access to a monthly pension of $400 a month, which is a very, very decent amount of money to sustain people in their retirement. And again, because this is such a glaring problem, and we are still going through the pandemic. If you look at what has happened in India, and frankly, this has happened in other markets as well, but the scale in India is much larger. So you have millions of migrant workers, right, who move from the villages into the urban areas to work. And they earn money on a daily, weekly basis in the construction sector, manufacturing sector, etc., and they send this money back home. Since they had no mechanism to actually participate in a savings scheme that would allow them to save for their retirement, what ended up happening was, when there was the lockdown, they had no access to monies. People couldn't feed their families. People who were living in homes couldn't give rent, and they were asked to, vacate their homes. So you saw an exodus of millions of migrant workers moving from the cities to the villages on foot, and this is a very, very dire situation. So as I put down the problem statement, but also an opportunity statement, and the reason I call it an opportunity statement is, like I said, if you see people putting down $1 a day of a saving towards their retirement, you're looking at, just within 5 years, just the 10% of that excluded population, which I talked about, if that is taken as a target segment, you would be looking at $1 trillion over 5 years of savings. That could be managed by asset managers. That would be interesting from the perspective of an insurer. So while you're doing good for society, you are doing it in an economically viable way. So there are monies to be made. It is not charity. There is money to be made, and you're still doing good for society. So I'll end it at that for now, because I know we'll be going into the solutioning part as well, Woody.
Thank you. Alex?
Thanks, Woody. Yeah, okay, so thanks everyone. I come from the InsurTech domain with a specific background in modeling large-scale disasters such as floods, earthquakes, and major climate events. So I'll be sharing my view of the problem statement from that perspective. How do we look at climate, sustainability, and InsurTech from a disaster risk modeling perspective? So when we look at this whole issue, I think there are two main problems that we have to contend with. The first of which is that climate change is causing more frequent, less predictable, more severe climatic events, such as floods, typhoons, storm surges, hailstorms, regardless of which part of the world we are looking at. So in technical terms, we would say that the hazard profile of the world is changing. The second problem that we have is that since the middle of the 20th century, we have gradually accumulated more and more assets, or what we call exposure, in very specific areas. So this can be industrial parks in Bangkok or residential homes and spaces in Indonesia. So what we see is that the population density and economic activities related to these areas are significantly larger than before and still growing. So risk and insurance basically lies in the intersection of hazard and exposure. So with gradually increasing and changing hazard and increasing exposure, this means that there's greater risk in the entire society for insurance solutions to tackle. So in my opinion, this includes both opportunities for quote unquote conventional insurance to capture, because the market is still very big for them. And also there are new forms of digital enabled insurance that we want to help enable. So in Asia Risk Transfer Solutions, what we want to do is our main focus is really on index-based insurance pricing and analytics. So we are third-party analytics provider to insurance firms. Basically, we support them and supply them with the data and the pricing models to create index-based enabled insurance. So instead of having to check a region hit by an earthquake, we can make use of things like the distance from the epicenter, the magnitude, the intensity of the earthquake to design the policy. And at the event of a really unfortunate earthquake, that particular parameter of that event will be used to administer the payout. So we focus more on the product and pricing side of things. And just like what Rachel was mentioning, that distribution is an important and huge critical factor when it comes to microinsurance. I think that all of these innovations coming together would definitely help to tackling the issue in some way. So I think this makes our conversation today very relevant and important to the how we move forward in the InsurTech space.
Thank you. These are all very interesting problems and big problems as well as opportunities. So what are the true innovation or solutions your company offers or your other peers offer to solve that problem, right? So maybe I will this time start with Alex first. So what is the unique kind of innovation you guys are doing, or say why is this problem not solved so far, and why is now a potential solution for it? Alex?
Okay, maybe I can go first.
Sorry? Yeah,
may I go
first? Yeah, I just reverse, yeah.
So about 4 years ago, in 2016, one of the major InsurTech projects that my team in Singapore was working on was the development of Asia's very first agriculture risk data platform called CRES, CRES. So we selected India as our launch market, as about 60% of the country's 1.3 billion population depend on the agriculture sector for a living. And many farmers at that point in time, they have pretty much limited access or little access to insurance for their crops and their livelihoods. So what we did, my team's technology solution addresses the major challenge in pricing and understanding and underwriting agriculture risk. And that challenge mainly is to do with running huge volumes of data through very complex statistical models. So what we actually managed to achieve is to deploy make use of big data and machine learning techniques in our core technology and help basically the underwriters and actuarial teams in these local insurance companies run dynamic risk models to analyze and quantify the risk of a particular crop. So, I mean, looking at it from a more of a performance basis, we managed to reduce the time needed to complete the technical analysis for a particular crop in a region from weeks, maybe 2 weeks that they have to code and develop the pricing, to a matter of minutes. So our launch partner was one of the largest private insurance company in India, IFCO Tokyo General Insurance Company, headquartered in New Delhi. So before working with us, they were underwriting a relatively small portion of agriculture risk, mainly due to the technical challenges in pricing and underwriting that I mentioned earlier. So at that time, before we worked with them, their total premiums written for the agricultural book was about $12 million in 2016. So today, after 4 years of working together and making use of the analytics that we provide, their agricultural insurance business servicing farmers has grown 20 times to about $250 million in gross written premiums this year. So all in all, if you talk about number of farmers, they are currently insuring to close to 4 million farmers all across India, across a huge variety of crops. So this is just one of the examples that I want to, InsurTech examples of how technology can.
Why is this doable now versus say a few years back? What is the kind of, is it new technologies, AI, just computation power availability, or is a smarter algorithm that makes it possible? What is the change?
Well, I would say that what we did was only one part of the whole puzzle of solving, or making the situation better. I feel that innovations usually build upon one another. So just to take this case of agriculture risk in India, the Ministry of Agriculture and Finance in India, they have invested quite heavily into drones and satellite imagery over the past 2 decades. Okay, so these innovations basically gave us the required scale of data needed to develop pricing analytics and validate models, right? So previously, at small scale, it wasn't possible to create any models. Now we have so much data that we have the wealth of information to actually understand them better. So so there's definitely a lot of room for collaboration and innovation between technology firms, the government, and of course the risk carriers, right? The insurance companies who are actually involved in making sure that the whole thing functions and passing the risk through insurance company to reinsurance to the government and so on. So so I think all in all, definitely the innovations, everyone has a part to play.
So what are the drone data you actually get to make it work? So
at least from our pricing and underwriting modeling kind of perspective, we are not so particular about, we do not make use of the data at its source. We actually take cleaned up production data. That is essentially what we care about when we build the most basic version of a model, right? So basically, we run analysis and statistical models to understand, for example, the distribution type of, say, losses or the variation of crop use of a particular region, right? So when we actually zoom out and look at it from a regional perspective, this might allow us to actually say that, actually in this part of the country, say in Maharashtra, where Bombay is, it is more liable to losses from typhoons or cyclones, for example. Whereas inland, it might be, extreme temperatures or droughts. So it's only when we have the data and the information to make these observations, then we are able to, calibrate and properly develop a model. So I hope that answers your question.
Yeah, thank you. Thank you. Next, Narata, can you explain your solution or in your innovation or company like you in how, solving this problem now that was not solvable before?
Namrata, sorry to interrupt. You're muted right now.
Oh, sorry about that. I was muted. So I was just saying that in talking about the solution, I'd first like to talk about the barriers that exist and therefore the solution to those barriers, which have prevented in jump-starting a micro-pension mass market. So first of all, the ecosystem for micro-pensions has so far been fragmented. While all the components do exist, these components don't come together naturally. So I'm talking about infrastructures which now a lot of markets do have. For instance, a digital national ID or a national ID, the ability to conduct digital payments, the ability to have pre-populated information. Not every market has that, but for instance, in Singapore, leveraging resources like MyInfo. And then, of course, very, very important stakeholders who are required to bring together the micro, pension marketplace, which would be your asset manager or a pension fund manager, insurance company, of course, pension tech, the technology that just helps you plug and play all these different stakeholders, which is, in this case, I'm talking about the technology solution that Pinbox provides. And also, a very good understanding of this segment, because it is just a reality that insurance companies and banks have for time immemorial been focused on high net worth, affluent, and mass segments, and do not have a very good understanding of this a huge population that sits below the mass segment and does not necessarily behave, think like the other segments that they have dealt with for a long time. So Pinbox helps to bring together, it's the glue that helps to bring together all these different stakeholders, as well as leverages the digital infrastructure that an economy has to put together this micro-pension marketplace. And I'll go into the platform, in a little bit, but just focusing on these barriers. The second one is commercial viability. And this is similar to some extent to what Richard had mentioned, where we have historically, and even today, traditional insurance companies and banks have, a traditional approach to distribution and incentive structures as well, which require large ticket items, as a result of which you wouldn't see agents interacting with the lower rung of society, whether it's farmers or fishermen or so on, because the premiums and the contributions that you're looking at there would be much smaller. And therefore, the need for extremely flexible products and very, very simplistic, fantastic user experience, intuitive interaction with this population and multiple channels, because this segment also should have the ability to choose how they would like to interact. And I'm going to talk about in a second. The other one is, of course, friction and barriers, right? In terms of cumbersome KYC, paper-based processes for onboarding and so on, which just create a huge hindrance and are also solvable through a good user experience and good digital interfaces. Last but not the least, I would like to highlight specifically on affordability constraints. And this also ties in very specifically to financial literacy. And frankly, financial literacy is not just a problem which is faced by the segments which sits below the mass segment, but in the industry like insurance and banking or financial services, financial literacy is still a problem where products are not necessarily simplistic, and an explanation around what the product is about is not necessarily human English simple speak. So when we're talking about farmers, fishermen, and so on, you are talking about them, having access to monies based on, like I mentioned before, whether you're manufacturing sector or micro SMEs, having access to monies could be daily wages, could be weekly, monthly. But then whenever there are life emergencies that strike them, they end up digging into their savings and depleting them. So there is no opportunity for being able to then accumulate your savings towards a pension. And I'll give you a very simple example, right? If I'm a farmer in India and my cow because cow is one of the main resources through which I'm able to till my land and so on and so forth. Cow is struck by a disease, I'm going to end up digging into my savings rather than having an understanding of the fact that, hey, I could have gotten an insurance for my cow, which I could have then leveraged as against digging into my savings. So financial literacy becomes extremely important, and integrated products being provided to the consumer across their life cycle, which takes care of all these different needs. So while these are the different barriers, first barrier that I talked about, fragmented ecosystem, Pinbox helps to bring together a digital marketplace with all the different ecosystem partners, and also a very, very good understanding of this segment, because we are live in various African markets and also now in Asia. The second one, which I talked about, was the disaggregated demand. So being able to help aggregate the demand, because obviously here we are talking about small contributions, right, on a regular basis. So you will only be able to see value when the solution scales. So also helping to be able to aggregate the demand through front-end distributors, and front-end distributors could be through integration with a gig economy platform. For example, it could be a Swiggy, it could be a Zomato, so on and so forth. But at the same time, also integration into microfinance institutions, right? Because these are institutions who are already in different markets interacting with this segment, and there is a trust relationship which already exists. So the agents of microfinance institutions can leverage Pinbox's front end, which is digital, but you could also have a face-to-face interaction through the phone. It could be a USSD phone, for example, if you were a customer in Rwanda who was using a feature phone and not a smartphone on which the platform operates. But at the same time, if you're someone, let's say in Singapore, you could leverage the app on the smartphone, or in India, a platform like WhatsApp, which is now being launched to almost 400 million of the working class population. So this takes care of the commercial viability part, because now you're talking about a digital platform. Your acquisition cost therefore becomes very small, negligible almost, but you are able to bring customers on through a seamless, easy experience. The third part I would talk about would be the ability to make these products extremely flexible, extremely simplistic. And again, to put it in perspective, right, which I have worked in an insurance company as well, and therefore I understand how difficult it is. It's a challenge for insurance companies, though they are now trying to work very hard towards making their products flexible. In the context of micro pensions, look, if I am, okay, let's take the Singapore example, yeah? Let's take a gig economy operator, for example. If I am a driver on a ride-hailing platform, okay, and I'm given the flexibility that I could contribute $10 per week of the rides revenue that come into my micro pension account. The product spec and the platform needs to allow for that level of flexibility. At the same time, if I'm a farmer in India, I have access to monies only twice a year. And why is that? Because twice a year, my crops get harvested, and that's when I have money. So I should have the ability to say, I will contribute to my micro pension account twice a year. So we are talking about that level of flexibility in terms of the product providers, in terms of the user experience. We're also talking about, so in the insurance world, we have a terminology called persistency. In very simple words, all it means is the ability to continuously contribute towards your premium, or contributing towards, for example, a pension plan. So ensuring that the explanation of the product, the trust relationship between the customer and the product provider is strong enough to ensure this persistency or this continuous saving. And Pinbox has done extensive amount of research on the ground, a lot of field work in terms of providing for retirement literacy. There are calculators that agents on the ground can use, whether they want to use it digitally or whether they It could even just be a piece of paper, which the end user, if I'm a 25-year-old sitting in a village in Indonesia, or I'm a 40-year-old farmer in India, I will be explained that, hey, if you continue to save, let's say 20 rupees a week, by the time you're 60, this is the kind of monthly pension you will have access to. So that's something that is available as well, and we've seen that work quite nicely. The other is insights in terms of more like psychological insights and behavioral insights that help people contribute. And I'll give you an example. In implementing the platform in Kenya, there was a time when people were not necessarily contributing as they got onto the platform. They would get onto a plan, but contributions were not very great. And in talking with customers, we realized that they were very, very diligent about paying, bills, whether it was their electricity bill, whether it was their any other utility bill. And when we explained to them the fact that they needed to make these contributions as a bill towards where they themselves are the recipient of the benefit, and we started putting out these alerts as bills, we saw the persistency go up. So that was a very, very interesting insight that worked as well. So
thank you. Yeah, Marita, sorry, I need to interrupt a little bit in terms of the time.
Sure, thanks, Woody.
Yeah, sorry. I think it's a very, very interesting. So in a way, you solve a lot of small problems and put together to kind of overcome the barriers, right? So I just noticed that Karina just joined. I want to make a brief introduction to Karina so that she can potentially add something. Karina has been in the climate insurance over the last few years at the AXA Climate, and before she was in Africa risk capacity. And interestingly, she was also a banker and a journalist before. So that was a very intriguing background in terms of getting into this InsurTech space. So Karina, I want to give a brief, maybe 2 minutes, to just summarize what is your problem that you want to solve, and maybe also briefly the solution that you are solving. Sorry, because you joined a little bit late, so we're running out a little bit time. So Karina, maybe can you just talk a little bit on your problem and your solution? Can you hear me, Karina?
Oh, Karina, I think you are muted right now. You can unmute yourself. It's on the top left. Oh, top right, sorry. So top right, you can unmute yourself. It should be next to the leave button where you see the turn camera on, mute, and the share content on the top.
Maybe, Karina, if you have trouble, maybe we start with Richard first, and you try to unmute yourself. So maybe Richard, can you continue with your solution?
Sure, yeah, happy to. Thanks, Woody. Yeah. So yeah, I mean, the problem that I identified is that insurance companies have been around for decades, and yet the majority, 97% of people don't have insurance, and my sense was that this was down to the distribution. So we started to look at the distribution and realized that if we wanted to sell policies that cost between, say, 3 cents to $1 a month, which is what we're doing, that we couldn't go directly to the consumer. So we couldn't have a direct sales channel to the consumer. Initially, it just wasn't going to work. I mean, this is back in 2002. This is kind of way before fintech. This is when, broadband was still through dial-up, and people had, gray screen phones. Smartphones really weren't a thing. So we started to work through a range of kind of B2B partners. Started off with microfinance organizations, and then in 2009 we graduated onto mobile phone companies. and that really kind of accelerated our growth to tens of millions. We ended up serving, more than 60 million customers in partnership with these mobile phone companies. What we identified was that we needed to work with these B2B partners who had three things. So they needed to have a large number of customers. They needed to be trusted. And what we realized was that trust is really about frequency of use. So we were looking for organizations that people used frequently, because that then reinforced that they were trustworthy. And then finally, they had to have a payments mechanism. So what we discovered was that the biggest source of friction in the customer journey was around collecting money from people. And so if you ask someone to kind of go to a third-party system and make a payment, they just never would do it. So overcoming that friction, overcoming that apathy, it became really essential to have a frictionless onboarding process, which included the ability to kind of collect money, time balance, a little bit like the ringtone model, where people are paying for ringtones and you're deducting small amounts of money, all from their mobile wallet. And what we discovered is that there were really kind of a number of different ways. So we could work with, microfinance organizations, we could work with banks, we could work with employee groups, mobile networks, mobile money, increasingly ride-hailing companies. But what we found across all of these different platforms was that there were really four different models for distributing insurance, for selling insurance. So the first one was that you could use insurance as some way of changing consumers' behavior. So, for example, you could use insurance to get someone to open an account or use an account. And when you monetize that change of behavior, there was a comparison between, say, using insurance or using other forms of marketing. So it became like a marketing spend. And when you monetize that change of behavior, that was at the core of this kind of business model. The second model was a bundling, so where you put together insurance with other services. And the reason that we did this was because it was a little bit like trying to get children to take medicine. Sometimes you have to give them a sweet or something like a piece of chocolate along with the medicine to make them swallow the medicine. And what we discovered was that people want to have insurance, but they also want to have something that they can use immediately. So if you bundle insurance with something that they can use today, then they're much more likely, they do want to buy the insurance. They know that it's good for them, but they don't really, they want to have something which they can also use today because they don't have so much money. The third model was around kind of using insurance to kind of change the loyalty of agents and employees, especially in the mass market and the gig worker section. So we were working with Uber, for example, in Pakistan during the COVID period, and they were starting to hemorrhage drivers during lockdown because there was no work to do, and they were terrified that when lockdown ended, they would have no drivers for the expected surge of passengers. And so they started to offer them health insurance. And what they discovered was that the drivers were willing to stay with them on the platform during the lockdown, even though there was no business, because they didn't want to lose their health insurance because they were worried about COVID. So therefore, and so this was a fantastic way of overcoming the cost of re-recruiting drivers after lockdown. So using insurance as a way of kind of trying to retain gig worker bases has been quite a significant source of business. And then the final model is, of course, over-the-counter sales, selling directly to the general public, but through a B2B or a B2BC model. But this one with insurance, I mean, really, I think, no one wakes up wanting to buy insurance. We've discovered this time and time again, that they really don't wake up wanting to buy insurance. And so if you just passively put insurance in a banner ad or somewhere kind of passively on the shelf, no one's going to buy it. So we were working with a big mobile wallet in the Philippines, and they had on their mobile wallet, all the normal kind of functions like send money, pay bills, buy airtime, and they added a menu for insurance, and they allowed insurance companies to just passively put the insurance products on the shelf, and they were selling like 2 policies a week because no one wakes up wanting to buy insurance, right? And they came to us and asked us to try and help them kind of overcome this. And what we said is, look, you need to, if you want to sell insurance, you need to own it. So, you need to kind of take hold of that product and actually sell it. And so the way to do that was, at the time where kids were going back to school, when you could see people using the wallet to pay school fees, send them a message saying, hey, if something happens to you, do you want your kids to finish school? And then the take up for insurance was significantly higher. So actively taking ownership and putting your brand on that, it becomes really, really important. So that's the way that we've overcome this distribution channel by partnering with B2B partners and then understanding the ways that friction can be removed from the customer journey and understanding how people actually sign up for insurance. That's been our innovation.
So I think, but fundamentally, I mean, your distribution cost can be substantially lower than the conventional insurers, right? Mainly because
Sure. Absolutely, yeah. I mean, we were serving like 65 million customers, and we had an overhead which was 6 people, so it was entirely digital, right? Because we had no choice. We couldn't start when you're selling a product that costs 3 cents to $1. You can't start with the big overhead. You have to start with the digital, with the low cost. There's no other way of doing it, right? So when we started in 2002, we had to be digital way before the rest of the market. So we didn't have that kind of analog hangover from the past that had to be overcome. We had to go digital right from day one.
But why is every single layer of value chain suddenly motivated to do this, right? Traditionally, they could not be motivated to do small policy.
So we started off when we started MicroInsure. We recognized that there was this kind of B2B organization that owned the customer and owned the payments channel, and then there was this kind of balance sheet, which was the insurance company, and we were in the middle, right? So our job was to design the product, to sell the insurance, to collect the premium, to educate the consumer, and to kind of help in the claims process. So we were like we were kind of overcoming this kind of digital issue. The problem was that we couldn't really get paid enough, right? So the issue was that as a kind of InsurTech, we were positioned as a broker because that was the cheapest way, the quickest way of getting to market. But the insurers just saw us as a broker. So they said, well, brokers get 10% or they get 20%. That's what brokers get. But we weren't the kind of broker that played golf. We were the broker who was designing the product and selling the insurance, and we were doing all the stuff. And what we realized was that the insurance companies, when they price risk, they allocate money to the risk rate, so the cost of paying claims. They allocate money to the cost of the capital, and then they also allocate money to the management fee. And those things are fixed. And what we realized was that we were doing the job of the management of the insurance company, and so they should have allocated to us that money which they were allocating to the management fee, but they weren't willing to because head office wouldn't let them or regional office wouldn't let them, even if they wanted to. And so we couldn't get. There was enough money in the value chain. So when you looked at how much money came to MicroInsure and how much money came to the insurance company, there was enough. There was enough to make the value chain work, but we weren't getting enough. Our piece of it wasn't enough. And so we recently became a reinsurance company. And the reason for doing that was we wanted to capture the whole value chain so that the economics then could work for us.
So that actually naturally leads to my last question. Sorry, we're running out of the time a little bit. Just very briefly, for each of you. So it is possible to do well and do good. So your kind of venture is a potentially profitable venture, but also serving the social good.
Yeah, so at MicroInsure, we were going for like 19 years. Our in-country operations were all profitable, and the problem for us was that we couldn't generate enough money in the countries to pay for the head office. And we had this very small head office of about 6 people, which were needed to provide services to the underlying kind of countries. And of course, we thought, well, if we just kind of scale up the countries, eventually we'll get to a position where we can pay for the head office. But every time you scaled the business, you had to add incremental expense to the head office. And so, the goalpost kept moving. And it just became very clear to me that because we weren't being paid enough, for the work that we were doing, we were never going to have a really sustainable model. When we became an insurance company, we just took the existing portfolio of business. So we didn't on day one, we didn't add any more business. We just took that portfolio and we became the underwriter. Our revenues increased 300%. Of course, so did our costs because now we're also paying the claims. But what was left out of the money, was more than enough to offset the kind of cost of head office. So we spent 19 years as a broker struggling to get to the point where we were break even, and we spent like the last 3 or 4 months being an insurance company, and we're instantly a profitable business. So my answer to your question is yes, but you have to have the right model, and you have to be able to capture the right amount of value for the work that you're doing.
Thank you, Richard. Namrata, what is your answer? Can we do well and do good?
Yes, absolutely. The answer is yes, Woody. That is 100% possible. And this is not just in the context of Pinbox, but is also a call out to insurers because, like I mentioned to you, putting in place a micro pensions ecosystem, you need all the stakeholders in place as well, which is managers, insurance companies, because there are multiple parts of the process which need to come together. So I would say not just for Pinbox, in terms of being profitable and being able to make monies. It is also absolutely possible for insurance companies, and I would therefore call out to insurers and asset managers to become a part of this movement because it would be very arrogant for me to say that, yeah, Pinbox alone can solve this massive problem. We need the whole ecosystem to come together with huge humility and absolutely. I'm in agreement with Richard that the kind of model that you put in place has to be a sustainable one, and that's the one I've just explained, which is digital distribution, but with the right kind of experience, the right kind of product flexibility. And I think there is a huge opportunity out there for the big corporates also to come in and be profitable and do good while making money.
Thank you. Alex, can we do well and do good at the same time?
Yes, of course. I mean, I just want to add one point, which is being a kind of a technology vendor to insurance companies, our view of it is quite somewhat different. So because we work fundamentally at up the value chain where we actually developed new innovative products where there might not even be a market right now, commercially. So what we actually do is rather than, working the typical business model where, the insurance company pays us a fixed licensing fee, a flat fee for the year, which is, can be quite significant, and they might not want to do it because the new product might not, be successful, for example. So what we actually do, our approach of approaching this kind of win-win, business relationship is to tag it to the performance of the portfolio actually. So let's say we talk about the agriculture space and we talk about new weather-based insurance products. Then usually what we would do is we will approach the relationship with insurance companies like a partnership, and we agree to we will take care of the technical capabilities for them, and we will share basically a slice of what they actually pay brokers or whoever, a slice of the premiums, like 1-2%, for example. So yeah, I mean that's how we look at it as well. Thank you.
Let me give you a try. Karina, can you talk now? Sorry to have some issues.
Yes, I'm so sorry. I had to join through my phone.
Okay.
What was the question? I didn't actually get
Okay,
the question.
first question is the problem statement, and then the second question is solution. And then the last question is, can we do well and do good at the same time?
Okay, perfect. I'll whiz through it because I'm sure we're at the end of time. But I think probably from a lot of what Alex and Richard have said, it's very along the same veins. The problem statement for AXA Climate is very, and the world is very much that there's a $520 billion annual average lost consumption due to natural disasters, according to the World Bank, and this is exactly the kind of impact that we're trying to reduce. So only a small portion of this is insured. Obviously, insurance is not the answer to resolve this whole figure, but it does help a lot. How we are aiming to do something is basically through early warning systems, through parametric insurance, which I'm sure Alex has gone through a lot. Making sure we're leveraging technology, making sure we are using machine learning, satellite technology to try and get payments out very quickly to affected governments, to affected farmers, to affected populations, so that they can recover much quicker. And then I think also trying to work on the data analysis side as well, is looking at what the future impact of climate change is going to be, how is actually going to balloon. That figure is going to get even worse in future because of climate change. And what can we do about it? Trying to understand where the most efficient investments that can be done today can be made on adaptation, and then kind of bundling that together with the insurance, because otherwise insurance obviously will just get more and more expensive as climate risk increases over time. So I think that's what we're trying to do, how to solve the issue. We've at AXA, we've obviously got a lot of local entities all over the world, which really helps, I think, on having that local knowledge. It's very key to be able to help, for instance, a government in a specific country to be able to understand what the context is, the language, the way that they're approaching the issues, what works in a certain context, what works and what doesn't. And so I think having those local insurers on the ground really gives that extra knowledge. And then obviously we've got our team of climate hazard specialists who are working to create very tailored parametric and index products for whatever is the appropriate context. And I think the last question is really around, examples of impact. And I think just recently, we're supporting these big natural catastrophe risk pools, which are essentially groups of governments buying parametric cover for typhoons, for cyclones, for earthquakes as a group, which brings down the cost. And Nicaragua is part of the Caribbean and Central American risk pool, and they just got hit by Cyclone Eta and Cyclone Delta, I think, Iota, in quick succession. And they've been able to receive, I think it was over $20 million within a few days. So, because we're able to get the data, the wind data immediately, we don't send anyone out to go check. They can just get this massive surge of liquidity right in the aftermath. And that's been used to, I'm assuming, we haven't heard the reports, but I'm assuming in the past, these kind of payouts are used for emergency cash handouts, emergency food, emergency shelters, reconstructing bridges and critical infrastructure so the economy can really get started as soon as possible. I don't know if I've got time for another one, but I think, on the agriculture side, maybe Alex, you've also given, and Richard have given some examples, but, we've set up a drought scheme in Cote d'Ivoire with the World Bank, working on satellite inspiration data. And the same thing, there was a minor drought this year. It wasn't that major, but, we're able to get the money to the farmers before they start these negative coping skills, like selling off their productive assets, like, pulling the kids out of school, stopping eating as much, which really creates poverty traps. So if you can get the money quickly, that brings down the cost in total, and it avoids these big kind of barriers and development gains. So, and one last example, because it's very specific to Singapore, is the CDRIF, which the World Bank is working with the Monetary Authority of Singapore. The MAS has been absolutely incredible. They're doing all sorts of insurance initiatives that I'm sure everyone in the audience as well is aware. But the CDRIF is really, I think, very special because it's a kind of a very flexible platform where all the ASEAN government members can really benefit from risk transfer, but also from knowledge transfer. So I think they're understanding how to be very effective in transferring the risk parametrically. The first step is through is flood risk for emergency flood costs, which I think Myanmar and Laos are looking into, but all the others are observing and they're taking part of the meetings. They're looking to maybe expand it into public assets cover, which a lot of the ASEAN countries don't have. So, I mean, kind of filling in these very big basic blocks will really help the vulnerable populations.
So last question, simple answer. So you think we can do well and do good at the same time?
Yes, for sure. I don't want to repeat what I've said, but I think maybe the examples I've given show that you can be clever about it. You can be efficient using the technology side. This is not CSR that we're doing. This is our core business. Half of our portfolio is dedicated to public sector, to helping agriculture and smallholder farmers, etc. It's not that we're making lots of money. We obviously subsidize that with the corporate side, which is maybe a little bit more margined, but we're able to do sustainable programs, and it's definitely, we're doing well, we're doing good.
Thank you very much for the 4 panelists. I'm very kind of impressed. I learned a lot. I feel very positive that this thing is really going well. So I know that we're running out of time. We actually overrun. Any questions from anybody in the audience?
Sorry to interrupt. Currently, there's no questions.
Okay. So thank you again. We will conclude this panel. Again, very much appreciate everybody. Thank you.
Thank you.
Bye-bye.
Thank you very much.
Thank you.
Thank you.
Thank you.